You watch a stock like Nvidia or Tesla create life-changing wealth, and you think, if only I'd spotted it earlier. It's frustrating. It feels like you're always one step behind the market's biggest wins. But here's the good news. There's a repeatable way to find the next big winners, and they're usually hiding in plain sight. Today, I'm walking you through the exact 5-step framework I use to spot high-quality companies before the rest of the market catches on. This isn't about penny stocks or get-rich-quick schemes. This is about finding wonderful businesses at fair prices. Stick around, because Step 4 is a metric that separates the pros from the beginners. And if you can get that one right, you're way ahead of most investors. Real quick, before we dive in, this is educational content only. I'm not telling you what to buy. Always talk to a qualified financial advisor before making investment decisions. First things first, let's clear something up. Undervalued does not just mean cheap. There are thousands of stocks trading under $5. Most of them are cheap for a reason. They're value traps, sinking ships, and you'll go down with them if you're not careful. True value investing is about finding a stock trading way below its actual worth. Think of it this way, you're not shopping for any cheap car. You're hunting for a pristine Porsche that's been accidentally parked on a used Kia lot. Wrong price tag, right quality. The quality is there, the price is just plain wrong because everyone walked past it. That's what we're looking for, A-grade companies with C-grade price tags. This happens for a bunch of reasons. Market panic, temporary industry slump, or the company is just in a boring business that doesn't get headlines. Our framework does two things. First, find those A-grade businesses with strong fundamentals. Second, figure out if they're on sale. Get both of those right, and the odds are in your favor. Step 1. Start in the right place. Undervalued sectors. Here's the thing. Instead of searching the entire stock market, let's start by finding the right haystacks. Entire sectors fall out of favor with Wall Street. It happens all the time. The last few years, everyone's obsessed with tech and AI. Money is pouring in, and the prices have gone to the moon. But at the same time, sectors like energy, real estate, and healthcare completely ignored, sometimes even sold off. These boring sectors, that's where the best deals hide. Use a market heat map or sector performance chart. It takes 5 seconds, and you can see which parts of the market have been in the red over the past year. While everyone chases what's hot, you look at what's cold. After the 2008 financial crisis, even the strongest bank stocks were left for dead. That created a generational buying opportunity. Over the long haul, that's where wealth gets built. By focusing on an undervalued sector, you're not hoping to find one lucky stock. You're fishing in a pond packed with potentially underpriced companies. Classic contrarian move. Step 2. The Big 3 valuation metrics. Once you've found a promising sector, it's time to screen for individual companies. This is where we use a few quick ratios to get a snapshot of valuation. Think of these as your first-pass filters. First up, the P/E ratio, price to earnings. This tells you how many dollars you're paying for every dollar of the company's profit. Simple math. Stock price divided by earnings per share. Now, a lower P/E might mean a bargain, but context is everything. A P/E of 15 isn't automatically good or bad. You've got to compare it to the company's own history. More importantly, compare it to competitors in the same industry. If most companies in an industry trade at a P/E of 25, and you find a great one at 12, that's your cue to dig deeper. Next, the P/B ratio, price to book. This compares the stock price to its book value. That's basically what the company would be worth if it sold everything and paid off all debts. A P/B ratio below 1.0 means you could theoretically buy the company for less than its assets are worth. Super helpful for asset-heavy businesses such as banks, manufacturers, and energy companies. Finally, the dividend yield. That's the annual cash payment a company sends to shareholders. The yield tells you your cash return on investment. If a solid, stable company has a much higher dividend yield than its peers, that's often a signal that the stock price was unfairly beaten down. Makes it an undervalued income play. Bottom line is this. These three ratios, PE, PB, and dividend yield, are your starting toolkit. Use a free stock screener. Filter for companies in your chosen sector. Low PE, low PB, nice dividend yield. Step 3. Financial health check. So you've got a short list of stocks that look cheap on paper. Now for the big question. Is this a healthy, growing business? Or is this a value trap in disguise? Two things are non-negotiable: cash flow and debt. First, is the company actually making money? I mean real cash. Check the cash flow statement. A business that consistently brings in more cash than it spends? That's healthy. That's the oxygen a company needs. Second, is the company buried in debt? A mountain of debt can crush an otherwise great business, especially when the economy gets rocky. There's a simple way to check this: the debt-to-equity ratio, or DE. It compares total debt to the company's net worth. As a general rule, a DE below 1.0 is a good sign. It means the company has a strong balance sheet. But here's the metric that really separates the pros from the amateurs: return on equity, ROE. ROE tells you how good management is at using your money to make more money. Think about it this way. If you give the CEO $1, how many cents of profit do they generate in a year? An ROE consistently above 15%? That's fantastic. It's a sign of a truly high-quality business and management that knows what they're doing. When you find a company that looks cheap, has low debt, and has a high ROE, you've found something special. A business that's not just on sale, it's exceptionally well run. Step 4. The PEG ratio. Alright, this is the metric that can really give you an edge. It's how you find incredible growth companies at prices that are actually fair. It's called the PEG ratio, price to earnings to growth. Peter Lynch, one of the most successful mutual fund managers of all time, made this famous. He ran the Fidelity Magellan Fund from 1977 to 1990 and averaged about 29% returns a year. He used the PEG ratio religiously. You see, there was a problem with using the PE ratio alone. It ignores growth. A fast-growing company might have a PE of 30 or 40. Looks expensive at first glance. But if that company is doubling its profits every couple of years, that high PE could be totally justified. The PEG ratio fixes this. You divide the PE ratio by the company's annual earnings growth rate. One simple tweak, and now you have so much more context. And here's the number to remember. A PEG ratio below 1.0 is widely considered a green light. It means you're paying less for the stock than the rate at which the company is growing its profits. It's like finding a growth stock in the clearance aisle. This is where value meets growth. When you're scanning your list, the PEG ratio is your reality check. It helps you tell the difference between a stagnant value trap and a dynamic, growing business that the market just hasn't woken up to yet. Step 5. The moat. Numbers only tell you half the story. For the final step, we need to ask a question Warren Buffett made famous. Does this company have a durable competitive advantage? He calls it a moat. A moat is what protects a company from competitors. It's that special something that keeps customers locked in and rivals locked out. Moats come in a few flavors. 1. A powerful brand. Think Coca-Cola. Think Apple. People will pay more just because of the name. 2. Network effects. When a service gets better as more people use it. Think Facebook. Think Instagram. 3. High switching costs. When it's a massive pain for customers to leave. Think about a business switching away from Microsoft's entire software suite. Not happening easily. And 4. Cost advantages. When a company can do things cheaper than anyone else. Think Amazon's delivery network. Think Walmart's massive scale. Before you invest, you should be able to explain, in simple terms, what the company's moat is. If you can't figure out what makes it special, it probably isn't. And without a moat, profits are never safe for long. Finally, ask yourself, do I actually understand this business? Can I explain what it does and why it'll be bigger in 10 years? If the answer is no, take a pass. The best investments are always in businesses you can easily understand. All right, let's bring it home. You now have a 5-step framework to find high-quality, undervalued stocks before they take off. Step 1. Start in unloved sectors. Go where nobody else is looking. Step 2. Screen with the big 3, PE, PB, and dividend yield to find candidates. Step 3. Do a health check. Look for low debt and a high return on equity. Step 4. Use the PEG ratio. Find growth on sale by looking for a PEG below 1.0. Step 5. Find the moat. Make sure you understand its long-term competitive advantage. This isn't some magic formula, but it is a logical, repeatable system that'll give you a real edge. It takes patience, but the reward is finding incredible companies at a discount and holding on for the long ride. The goal isn't just to find a stock that pops next week. It's to find businesses that build your wealth for years to come. Let me know in the comments which of these steps was the most eye-opening for you. And if you haven't already, hit that subscribe button for more deep dives into smart, long-term investing. Thanks for watching. I'll see you in the next one.